Yes, you read that correctly. In this 3-part video series, I'm going to describe 23 different ways you can finance a rental property. Not all of these ways will be available to every investor or will apply in every situation, but this will give you a very good idea of what is possible. Depending on your experience with real estate investing, you may have heard of some or most of these methods, but I think you will find at least one or two that you have not previously considered that may actually help you in your real estate investing journey. Hey guys, if we're just meeting, my name is Vitaly Volpov. I'm a practicing attorney, an active real estate investor, and a part owner of a real estate brokerage in upstate New York. I've been successfully investing in cash-flowing rental properties since 2011, and I currently have 68 rental units in my real estate portfolio. On this channel, I discuss relevant legal concepts as well as best strategies and tips for real estate investing and personal finance. If you're new to the channel, consider subscribing and hitting the notification bell so that YouTube notifies you of all my future content. Nothing that I say in this video should be construed as legal or financial advice, and the views and opinions that I express are my own alone and don't necessarily reflect those of my law firm or any of my business partners. So I'm going to break this list up into 3 parts to make it easier to follow. The first part will deal with owner-occupied financing, in other words, financing of a rental property where the owner will live in part of the property and rent out the rest, aka house hacking. The second part will deal with non-owner occupied financing, in other words, financing a rental property purely as an investment where the entire property will be rented out to tenants. And the third part will deal with other creative financing, which could in theory be used for either owner-occupied or non-owner occupied rental properties. I will put a timestamp table of contents in the description below so that you can quickly skip around to the particular method or methods of financing which interest you more. One last thing, keep in mind that this is not an in-depth discussion of each method, but rather an overview. If you'd like me to go into more depth on any of the methods that I will talk about, let me know in the comments below which methods you are interested in, and I will do separate, more in-depth videos on those. Alright, so for owner-occupied financing, we start with method number 1, the good old vanilla conventional bank loan. Now, I think that almost everyone who has invested in real estate or is considering investing in real estate has heard of this type of loan. Essentially, it is a residential loan with a banking institution with which a borrower can finance up to a 4-unit residential rental property where the borrower will actually live in one of the units. The minimum down payment that I have seen with this type of loan is 5%. Some banks will require a larger down payment, but most will not require a down payment less than 5%. The term for this type of loan can be up to 30 years, but can also be much less, even as short as 5 years if that is something that the borrower wants to do. Obviously, the shorter the term, the larger the monthly payment, and the harder it is to qualify based on debt-to-income ratio. Debt-to-income ratio, referred to as DTI, is a metric used by banks to determine the level of risk involved in a particular borrower being able to afford the payments on a particular loan. There are actually 2 different types of DTI ratios that banks will look at: front-end DTI and back-end DTI. Front-end DTI is the borrower's total monthly housing expense, i.e. the mortgage expense, divided by the borrower's gross monthly income. Generally, banks will not agree to finance a conventional loan if the front-end DTI exceeds 28%. Back-end DTI is all of the borrower's monthly expenses divided by the borrower's gross monthly income. Generally, banks will not agree to finance a conventional loan if the back-end DTI exceeds 43%. All in all, if you can qualify for this type of loan, and if your lender has a down payment requirement as low as 5%, this may be an option to consider when you're planning to live in one of the units in your rental property, as long as the property is 4 units or less. Method number 2 on the owner-occupied financing list is a variation on the conventional loan. It is a loan that you obtain from a portfolio lender. An explanation of what a portfolio lender is requires us to delve a little bit into what banks do with their mortgages once they issue them. In a conventional loan financing arrangement, the bank will often sell their loan on the secondary market to other financial entities. The secondary market is somewhat convoluted and complicated with several layers of transfers and sales, which I'm not going to get into in this video. But suffice it to say that the biggest end-user investors in mortgages are the government-sponsored enterprises Fannie Mae and Freddie Mac. Because Fannie Mae and Freddie Mac are government-regulated entities, they are permitted to invest only in those mortgages that fit a specific criteria. What this means for borrowers is that the bank, which is lending through a conventional loan that it will resell on the secondary market, cannot deviate from the terms on which Fannie Mae and Freddie Mac will eventually purchase it. So for example, on a conventional loan, a bank cannot deviate from the minimum down payments or the minimum DTI requirements. This is not the case with a bank that keeps its mortgages on its balance sheet. In other words, this is a bank which does not sell its mortgages on the secondary market, but rather keeps them in its own quote-unquote portfolio. What this means is that sometimes a borrower may be able able to get a better deal on some of the loan terms from a portfolio lender as compared to a conventional lender. Portfolio lenders are typically local regional bank chains or credit unions. They're not national Goliaths like Wells Fargo or Chase Bank. Not all portfolio lenders will have better terms than conventional lenders, but it may be worth doing some research to find out what portfolio lenders exist in your area and what their lending terms are for a particular type of property that you're trying to purchase. Method number 3 on our owner-occupied financing list is another household name. No pun intended. It is the Federal Housing Administration loan, known by its acronym FHA. While the FHA is a government agency, this type of loan is still a loan that would be issued by a bank. Almost all banks, the large Goliaths like Wells Fargo and the local portfolio lenders that I mentioned a moment ago, offer this type of loan to qualified borrowers. The reference to FHA just means that the loan is insured by the federal agency. This means that if a borrower defaults and fails to pay the loan, the bank, or more accurately the investor institution which buys the FHA loan on the secondary market, will be made whole by the FHA. Because of this fact, the terms and the minimum requirements of an FHA loan are more relaxed than those of a conventional and even of a portfolio loan. Two major examples of the more relaxed requirements are the minimum down payment, which can be as low as 3.5%, and the minimum credit score, which can be as low as 580 points. Additionally, unlike the conventional loan DTI, the FHA loan DTI can be as high as 40% for the front end and 50% for the back end. There are various factors taken into account with FHA DTI limits, including the borrower's credit score, so you'll definitely want to check with your lender. As with the conventional loans that I mentioned, you can use an FHA loan to purchase up to a 4-unit rental property, with the requirement that you must live in it for at least 1 year. But there are a few downsides with FHA loans as compared to conventional or portfolio loans. And those include a generally higher interest rate, higher closing costs, and the fact that if you put down less than 10%, you will be required to pay mortgage insurance for the life of the loan. With a conventional loan, on the other hand, you would have the ability to cancel the mortgage insurance requirement once your equity in the property reaches 20 or in some cases 22%. This option is not available with FHA loans with lower than 10% down payments. Method number 4 is a much less frequently used but still useful cousin of the FHA loan, the FHA 203K loan. The FHA 203K loan has the same eligibility criteria as an FHA loan. However, it comes with an additional benefit. If the property you're looking to purchase requires expenditure of additional capital for renovations, the FHA 203K loan may provide the necessary financing for it. If you use the FHA 203K loan, you won't need to come out of pocket for renovations as much as you would with any other loan. This type of loan may also allow you to buy a fixer-upper property which would otherwise be unfinanceable with any other bank financing. As it turns out, banks generally don't like lending on properties that need a ton of work. The downsides with an FHA 203K loan are the strict contractor requirements, a lot more paperwork, red tape, and delay caused by several layers of oversight, and the fact that your construction funds are distributed to you in installments based on progress of the work. If you're looking for a fixer-upper project but are tight on funds, FHA 203K loan may be a good option, but definitely research it thoroughly and know what you're getting into before you apply. Method number 5 is a special loan program offered by select lenders and backed by Fannie Mae called the Home Ready Mortgage Program. This program is similar in a lot of ways to the FHA program, however it does have some notable differences. First, the Home Ready program allows a down payment of as little as 3%. Additionally, it allows borrowers to use borrowed or gifted funds for the down payment, meaning that a borrower can purchase a property entirely with other people's money. The borrower must, however, show that his or her income is at 80% or less of the area median income as determined in the relevant census tract. Additionally, the minimum required credit score is at least 620 points, and if the person is a first-time home buyer, he or she is required to complete a 4 to 6 hour online homeownership education course. With a home-ready mortgage, a borrower can purchase up to a 4-unit rental property and must live in it for at least 1 year. Additionally, the maximum back-end DTI with this type of loan cannot exceed 50%. If you can income qualify, a home-ready loan may be one of the best ways to dip your toes into real estate investing and purchase your first rental property. Last but not least, method number 6 is a Department of Veterans Affairs backed loan, which is available to borrowers who serve or have served in the United States Armed Forces. This loan can be used to purchase up to a 4-unit rental property, and get this, can be done with zero money out of pocket. This is a special perk which is intended intended to make housing as affordable as possible for our military personnel. In order to qualify, the borrower must meet certain minimum length of service requirements depending on which branch of armed forces he or she served in. The VA does not set limits on the borrower's minimum credit score or minimum DTI scores, so definitely shop around to see what different lenders say about these criteria if they are a concern to you. Some lenders will allow a back-end DTI as high as 60%. Additionally, there are no mortgage insurance requirements with VA loans, but there are some special origination or funding fees that are not required with other loans. If you're a veteran of the armed forces and you're looking to own or occupy a 1 to 4 unit rental property, you should definitely consider a VA loan as your financing method. So that's going to be it for the traditional owner-occupied financing methods that can be used to purchase a rental property. Question of the day for you guys: have you used any of these financing methods? Did I miss any? Let me know in the comments below. In part 2 of this video series, I will go through the traditional non-owner occupied financing methods. So keep an eye out for that video, which should be coming out in a couple of days. If you guys enjoyed this video, please do me a favor and hit the like button. And if you haven't yet subscribed, be sure to subscribe and hit the notification bell. Thanks again for watching. Have a great day, and I will see you in the next one. Take care.